Very good afternoon to the viewers of today's VCM on relevant valuation metrics in case of listed and unlisted companies under the aegis of Capital Market Committee of the Institute of Chartered Accountants of India, which is being hosted by Bharatpur branch of CIC of ICAI. We have the presence of very worthy chairman to the Committee for Capital Market and Investors Protection, C. Unlisted with us. Learned speaker, CA Pratik Singhvi, the hosting branch office bearers, including CA Rakesh Kumar Gupta ji, Vice Chairperson.
Amit, sorry to interrupt, but I don't see participants. I see still only 11 people.
No, you can't, sir. You can't. So, Rakesh Kumar Gupta.
We are having around 4,000 delegates at present here. Around 4,000 delegates are there from each and every part of the world.
So we have Rakesh Kumar Gupta ji, Vice Chairperson, Bharatpur branch of CIC of ICAI, Hemant ji, our co-opted member, CA Naman Gupta ji, and Bharat Bhushan ji, CA Bharat Bhushan ji, Secretary, Bharatpur branch of CIC of ICAI. So topic is very, very interesting, and I think we are eager to hear the learned chairman with his opening remark and the speaker. Before that, I would request CA Rakesh Kumar Gupta ji, Vice Chairman, Bharatpur branch of CIC of ICAI, for his welcome address. Over to Rakesh Kumar Gupta ji.
Thank you, Amit Agrawal ji. मैं राकेश कुमार गुप्ता वाइस चेयरमैन भरतपुर ब्रांच ऑफ CIRC CCIM IP का हार्दिक धन्यवाद देना चाहूंगा कि भरतपुर ब्रांच को ये मौका दिया तथा चेयरमैन श्री अनुज गोयल जी, वाइस चेयरमैन जय छारिया जी एवं अमित अग्रवाल जी सेक्रेटरी एवं समस्त CCIMP के मेंबरों का धन्यवाद देना चाहूंगा कि अपने भरतपुर ब्रांच को इस योग्य समझा तथा अब मेरे सीनियर मेंबर्स और यंगर ब्रदर्स को भी हार्दिक धन्यवाद देना चाहूंगा जो कि इस मीटिंग को ज्वाइन कर रहे हैं तथा सबसे ज्यादा धन्यवाद अपने सेशन चेयर में सेशन स्पीकर श्री प्रतीक सिंघवी जी का भी धन्यवाद देना।
Thank you, Vice Chairman sir, CA Rakesh Kumar Gupta ji, for your very warm welcome address. And now I request CA Hemant Kumar Agrawal ji, Sikasa Chairman of Bharatpur branch of CIC of ICAI, to take us a drive about the profile of CA Pratik Singhvi. Over to Hemant Kumar Agrawal ji.
Thank you, Mr. Amit Agrawal ji. CA Pratik Singhvi is a finance professional with over 20 years of rich functional and managerial experience in field of corporate finance and financial consulting. He currently is a managing director of with 9 Rivers Capital, a boutique investment banking and advisory services firm. He is a risk holding chartered accountant, a risk holding cost accountant, and MBA finance. Additionally, he has also completed management development program in advanced corporate finance from IIM Ahmedabad. He has conducted workshop worth over 100 CP hours till date with the ICAI and its regional offices and its various study circle as a speaker faculty. It is my pleasure to introduce CA Pratik Singhvi. Thank you.
Thank you, Hemant ji, giving a brief about our today's speaker. So it will help us that we are fortunate enough to having the Pratik Singhvi ji in our as a session speaker. Now we have a very, very young and dynamic option of the Committee for Capital Market and Investor Protection, CA Naman Gupta ji with us. The Naman ji is the co-opted member in the Committee for Capital Market and Investors Protection. And with few months of his option, I think he has contributed like anything. In few of his months contribution in the committee, he has suggested so many topics to us. He helped us in drafting various documents and he's reviewing various documents. So we are very thankful for him that he is contributing in a very real sense and great sense in the committee. And today, let me take this opportunity to thank him And at the same time, I would request him, CA Naman Gupta ji, to introduce my chairman, C. Anuj Goyal ji. Over to Naman Gupta ji.
Thank you, Amit Agrawal ji. Thank you all of you for the kind pleasure. I am introducing C. Anuj Goyal ji, the Central Council member of the Institute of Chartered Accountant of India. With his 14 years of experience in council, 3 years in regional council, 6 years in branch, he contributed immensely in various capacities. Presently, is the chairman of the research committee, the oldest committee of ICAI, and capital market and investor protection committee of ICAI. He is also vice chairman of corporate law and corporate governance committee with exemplary academics. He possesses CA, company secretary, CMA, LLB, MCOM, DISA, and DIRM. He is a very visionary chairman of our committee. So I am pleasure to introduce
Thank
C.
you,
Anuj
Naman
Goyal
ji.
ji.
Thank you,
Over
Naman
to
ji,
Anuj, sir.
giving a academic background of C. Anuj Goyal ji and what he did. Let me take a drive and introduce C. Anuj Goyal ji. I worked with him for quite few years, not less than 7 or 8 years with him in the various capacities as a secretary to various committees as he was chairman. Let me share with you that Anuj ji is a person who started his professional life at the age of 22 years with the qualification of all the 3 institutes. At the same time, he started contributing in the profession. He was the person who led the 3 of the professions from branch level. He was the 6 years he devoted in the Ghaziabad branch of CRC of ICAI. He was the chairman of ICWI, the Ghaziabad chapter. He was the chairman of ICSI, Ghaziabad chapter. Then he moved to Regional Council of the Institute of Chartered Accountant of India. And he served there and led the CIC as a chairman. At the same time, when he was a chairman, he was the Central Council member elect for the Council of the Apex Governing Board of the Institute of Chartered Accountant. Let me share with you that this is the 5th term of the C. Anuj Goyal ji in the Central Council, the Apex Governing Board of the Institute of Chartered Accountant. And during his tenure as a Central Council member, if I recollect correctly, none of the committee, I don't think none of the committees left. I think he has served in all the committee as a chairman, vice chairman, or member. Presently, I think Namanji has already described, so there is no need to describe other things. And we have the speaker of the day with us. So we are eager to receive very, very valuable inputs as a opening remark from our chairman. So I would request the worthy chairman, C. Anuj Goyal ji, to present his opening remark and take us a drive for what is going to be deliberated in this session. Over to C. Anuj Goyal ji.
Thank you, Dr. Amit Agrawal ji, our young and dynamic secretary of our committee on capital markets and investors protection and the research committee. And friends, I am really grateful to all our honorable members of the Institute of Chartered Accountants of India who are trying their level best to see that how they can really do something concrete in this time of crisis also. They are involved in the knowledge enriching activities. We are in this webinar also, we are having close to 5,000 chartered accountants from each and every part of the world. And we are trying our level best to see that how our chartered accountants can remain engaged in the knowledge enriching activities and can try to update their skills, can try to enrich their skills so that they can not only serve the profession but also in turn can serve the society and nation. I welcome on behalf of the Institute of Chartered Accountants of India and on behalf of Bharatpur branch, our honorable resource person, very prominent chartered accountant, CA Prateek Singhal ji. And I welcome all our honorable office bearers of very, very prominent Bharatpur branch of the central region. We are having our vice chairman of the Bharatpur branch, CA Rakesh Kumar Gupta ji. We are having Secretary of Bharatpur branch, CA Bharat Bhushan ji, and my very, very good friend, CA Hemant Kumar Agarwal ji, the Sikasa chairman of the Bharatpur branch. And of course, we are having our honorable co-opted member of Committee on Capital Markets and Investors Protection, CA Naman Gupta ji, a young and dynamic chartered accountant present here. And I welcome all our honorable viewers who are present from each and every part of the world. We are having the presence of around 5,000 chartered accountants. And we are really, our chartered accountants are proving that they are real partners in nation building. And they are very well taking the part in a very, very active manner in the initiatives of the Institute of Chartered Accountants of India, our Committee on Capital Markets and Investors Protection and Research Committee. And I'm quite confident that with the support of all our honorable members, we will certainly prove ourselves as true partner in nation building. So I once again welcome all of you. Friends, Institute of Chartered Accountants of India has always worked at providing requisite training and equipping its members with the necessary skills and knowledge required to spearhead our country towards economic prosperity. Against this backdrop, the committee has come up with this virtual CPE meeting on the relevant valuation metrics in case of listed and unlisted companies. The Committee on Capital Markets and Investors Protection of Institute of Chartered Accountants of India has been entrusted with various responsibilities like providing suggestions on various bills, regulations, notifications, circulars, and other documents relating to capital market for submission to the government, the regulator, initiating research studies in the field of capital market and investors protection, conducting training programs for members and others on matters relating to capital and commodity markets. Friends, the Committee on Capital Market and Investors Protection works in the area of promoting investors protection by nurturing capacity and competency development of members and stakeholders in the capital market. The committee will be actively working in the area of financial literacy for the development of economy through various initiatives to educate and empower citizens. The committee also works to develop competitive workforce for capital market and corporate through its various learning initiatives like workshop and training programs on capital market. It conducts two flagship, very, very important flagship certificate courses for professional development of chartered accountants in the field of forex and treasury management and derivatives. In fact, one of very, very important decision which has been taken by the Institute of Chartered Accountants of India is to allow members to trade in derivatives in individual capacity, which is a very, very important decision for the benefit of membership at large. In our very first meeting of Committee on Capital Markets and Investors Protection, we have taken the decision that the chartered accountants may be permitted to deal in equity derivatives in individual capacity. Besides being in practice, if Bharat Bhushan ji is in practice as a proprietor, or Rakesh Gupta ji is practicing as a partner along with Hemant Agarwal ji, then besides being full-time practitioners, they can very well have the income from equity derivatives, and then that income will be treated as income allowable to the practicing chartered accountants. So the Council of the Institute of Chartered Accountants of India ultimately decided to have this decision, and that shows the importance of the capital market for the chartered accountants and how the chartered accountants are very, very relevant and very, very important player in the field of capital market. I think the best suited professional across the globe in the capital market is none other than the member of the Institute of Chartered Accountants of India. No professional can better understand the nitty-gritties of the capital market than a member of ICAI, which is the best accounting professional across the globe. And I'm quite confident that all of us will certainly try to grab this very, very important opportunity which is coming forward in the capital market. And if India has to reach to the 5 trillion economy target of the Prime Minister Modi, I think it is very, very important that our capital markets should be very strong, and the chartered accountants have to play a very, very important role in this matter. Friends, the valuation metrics are comprehensive measures of a company's performance, financial health, and prospects of our future earnings. These are the ratios and models that can give investors an idea of what a company may be worth. Valuation metrics belongs to the larger family of financial statement metrics. These use data from a company's income statement, balance sheet, and other financial accounting sources to measure the strength of the company's financial performance and financial position. Valuation metrics and models can be invaluable when assessing the stocks to invest in. These ratios are by no means fail-proof, but they can give an idea of whether a stock is trading at premium or discount to its fair value based on profitability, growth, and its balance sheet. Valuation ratios are invaluable for any type of stock picking or active investment strategies. They can be used to compare stocks and select those with the best chance of generating a return. Rightly said by Joel Greenbelt, the secret to investing is to figure out the value of something and then pay a lot less. Having an idea of the relative value of stocks allows to take advantage of market volatility and corrections. So here in today's virtual CPE meeting, we will be discussing about the relevant valuation metrics which can be applied in case of listed and unlisted companies. With this, I will not be taking your further time as we are very, very eager to hear our honorable guest speaker, none other than the member of the Institute of Chartered Accountants of India, CA Prateek Singh ji, MD, 9 Rivers Capital, who will fine-tune the concept and throw the light on the relevant valuation metrics in case of listed and unlisted companies. I once again welcome all our honorable members of the Institute of Chartered Accountants of India. Around 5,000 members are here from each and every part of the country, rather outside country also. And I am really indebted to Bharatpur branch managing committee and all the members of the Bharatpur and Rajasthan and Central region for coming forward to be the part of this very, very important virtual CPE program for the professor. Over to Dr. Amit Agrawal. Thank you.
Yeah, thank you, Chairman sir, for your opening words and guiding words. Really, it was very insightful. You have given a brief about what is going to be deliberated. And yes, of course, I do agree with you that the speaker of the day is a very learned speaker, and not other than he is among us. He is one of our members. So he understands what is expected from the chartered accountant and how we can improve our role. So not taking much time, I would request the speaker of the day, CA Prateek ji, for his further deliberation. Over to CA Prateek.
Thank you very much. And at the outset, let me thank the ICAI and the CCMIP and CIRC for giving me this opportunity. Much appreciated. It's a pleasure always to give back to the alma mater. Here I have the opportunity to share whatever little extra that I have learned, because whatever I'm going to be talking about today is something that almost all of us have learned during our CA days. So it's not that I'm going to be sharing something more. It's just that I'm using this opportunity to help you refresh your memories or help you probably put things in context as to what you had learned then, possibly how to apply it in real life in either your own cases or in cases of your clients, etc., etc. Moving on. So the first thing that will probably come to your mind is what really is valuation. Okay, again, something that we have learned in our during our CA days. Very simply put, yeah, a fair market value is typically defined as a price at which you have a willing buyer, a willing seller, and they are ready to transact around an underlying asset or a company under ideal conditions, meaning they all have complete set of information and it is congruous. Both of them have the same set of information and they are not under any duress to transact. Okay, if these conditions are met, essentially you have a transaction, and when you have a transaction, you have the need for valuation. And see, there are two different sides of the same coin, a buyer and a seller. Now, imagine a transaction only happens when one thinks that it is worth selling at that price and the other thinks that's worth buying at that price. So perspectives do differ, which is fine, and that is how markets are created. How do we adjudge what is the fair value which a seller is willing to sell at or a buyer is willing to buy at? We will talk about that in just a bit. Okay, so no presentation on valuation will be complete without talking about the art versus science aspect of valuation. I will very briefly spend a minute or two here and then we will move on. So valuation is never only about numbers. Numbers is indeed important. Numbers cannot be ignored completely. But at the same time, if the numbers throw up a figure which beats common sense or which beats a gut. So typically, if an entrepreneur has been at it for about 15, 20 years, his gut will be able to give a better figure than all the valuation models in the world. Regardless, there is still, there's a nice blend of science with art, which will always give you a true fair value rather than only one of the two. Only gut feel will not help. Only science will possibly not help as much. It's always a nice blend of the two, which will give you correct valuation in any case. Okay, because numbers are important, but they are not the say-it-all. The bigger picture, the bigger story comes from beyond numbers. Again, no valuation discussion will be complete without talking about risk versus reward equation. Something that we had learned, if I recall correct, in what used to be called the inter-CA level, risk versus reward as an equation. Higher the risk, higher the reward. Lower the risk, lower the reward. As risk increases, expectations of rewards also increase. Right? And this expectation of reward is what determines the value. So in case of any underlying business, if the expected risk of that business increase, as an investor, my expectation of rewards from that taking that risk will also increase. And hence the value which I'll be ready to ascribe to that business will differ basis my expectation of how risky that is, and hence what rewards I wish to generate out of that. Simply put, even the best of companies, the company per se may be a great company. So fundamental analysis says this is a company absolutely worth investing in. If you're not buying it at the correct price, if you're not investing in the company at the correct price, that may not be a good investment. It may still be a good company, but doesn't mean it is a good investment. There's a difference between a good business and a good investment, which is where the valuation equations come into role play. So this is something I will have to sensitize you to, and earlier done the better. While we use the term value or valuation very freely, there are two different metrics of value. One is the enterprise value and the other is the equity value. There's a very small difference between the two, but nevertheless, it is important for us to be sensitive to it and understand it because if somebody is talking about an enterprise value and if you think he's talking about equity value, you probably are on two different planes. It's simply put, the enterprise value is the value of the business as a whole, regardless of its capital structure. So if you're buying the business along with its debt and liabilities, how much are you willing to pay? But if you're buying only the shares of the company, wherein the liabilities are not getting transferred or the liabilities are not being considered, then you're talking about equity value. Not a great difference, but at the time when you are actually doing some calculations, and I will highlight a few later in the presentation, you'll realize that the difference does the difference between the two has to be appreciated because it makes a difference. If you read the bold bullet, simply put, enterprise value less net debt is equal to equity value. This is a simplistic representation of the equation between the enterprise and equity value. And why the two need to be understood is, depending on circumstances, you may need to choose one over the other or use the two in conjunction. Depending on the circumstances, depending on the quality or the nature of the or the size or the stage of the underlying asset, you may need to choose between enterprise value metrics versus equity value metrics, and hence it's important to understand the difference between the two. Lastly, so not all companies are alike, and that's the reason why the topic itself, when we were discussing, we said, okay, let's actually split it into public versus private, because the valuation metrics that we use for public companies probably won't hold true as much for private companies, unlisted companies. Whereas the ones that we use for private companies, the unlisted companies, those valuation metrics may not hold true for public companies, because there's a clear difference in the nature of the two kinds of companies. Typically, I mean, while this is not exhaustive, and while this is not sacrosanct that all public companies fit into this and all private companies fit into this, but you'll observe that majority of the differences are fairly accurate representation of the differentiation between the private and the public companies. Typically, you will see if it's a publicly listed company, you know for sure that it is a relatively large company with large operations, been in existence for a while. It has reasonable segregation between management and owners. It will have multiple shareholders. A private company will not have multiple shareholders, 10, 20, 30, 40 at the most, 50 at the most, typically. In a public company, because of its size and age and stage of life, of development, the ability to forecast its cash flows is fairly stronger, whereas in case of a private company, it is a lot less. So the riskiness, because there will be a high delta between expected and the actual return. There's a possibility of a high delta, high difference between the expected and actual return. There is this riskiness associated with the cash flows that those companies are able to generate. Again, availability of data. In case of a public limited, it's a fairly organized and it is quick, whereas in case of private companies, you'll find getting data is always a challenge. Okay. And then obviously comes to valuations, the risk premium associated with a public investment, a publicly listed company or investing in that versus private, there's a difference. Private companies' investments are always higher. There is risk in the company itself. There's riskiness of you being able to exit, even if the company is doing well. So all that get captured into the expected returns, and hence the valuations get impacted. And while calculating valuations of public companies is relatively easy, and I'm not talking about just market cap, because that is clearly available on a day-to-day and actually an hour to hour, maybe second-to-second basis. I'm talking about in general valuing a company on a fundamental basis versus a private company. It's cumbersome, and we will see some nuances that one needs to worry about as we go along. Having said this, let's look at what the valuation metrics in case of listed companies are. Features we've already mentioned. It's easy availability of data, so relatively the reliability of the valuation metrics that one may calculate is higher. Again, because it is listed and you're fairly established about its business model, so establishing who the peers are from that industry group, that's also easier, and hence your preparing a data set of peers becomes easier. Normally, we use the DCF approach to valuation, which I will talk about in brief a little later, or the sum of the parts, which is relatively used in case of companies with very diverse, different kind of businesses, because each business will come with a different risk set, and hence different rewards expectation. So if there are multiple businesses, you compute the value of each of those businesses separately and then merge all those valuations together to find the total value of the legal entity. But so SOTP is something that I'm not covering given the time given for the coverage, but DCF very briefly, yes. Normally, you will see while they use DCF, when I say they, I mean research analysts. Research analysts use the DCF and or the SOTP approach to valuation for the primary valuation. And invariably, that is the comparable multiples approach is used for reaffirming the valuation arrived at. Okay, so I start from scratch as a research analyst. I start from scratch, build up the valuation model, arrive at a value. Now I use comparable multiples to ensure that the valuation that I have arrived at is within the range of the comparable multiples. If this is way outside the limit, I need to investigate whether there are any assumptions that I have taken incorrectly or whether that outlying or being an outlier is justified. So being an outlier is not a crime in itself, but at least that sensitizes, as a research analyst, it sensitizes you to ensure to check कि भाई अगर बहुत ऊपर नीचे है बाकियों से तो सब सही तो है ना, कहीं अपने से गलती तो नहीं होगी इवैल्यूएशन में, या maybe it is justified. If it is justified, great. Okay, and you use both enterprise value as well as equity value multiples invariably. I'll just give you okay. So what are the key factors which determine which one to use? Enterprise value use करना चाहिए, मतलब enterprise value metrics use करने चाहिए या EV multiples valuation metrics use करने चाहिए? And that, as I was saying earlier, will depend on many things, including the size of the company, the stage at which the company is, the size of the industry per se, the kind of transaction that you are doing, the accounting regime that the company is in, whether the company is profitable or not. So performance पे भी अगर profit ही नहीं है तो equity value multiples लेके those will not throw a correct result. Then you will have to necessarily stick to enterprise value multiples. There are certain industries where it is almost a given, it is better to use enterprise value rather than equity value. There are certain industries where the opposite is true, where you would prefer to choose only enterprise value and, equity value multiples, and enterprise value multiples have no role to play in those industries. Banks, for example. Okay, let's look at what comps multiples calculation involved. It's again not a rocket science. All we are doing is simply identifying comparable companies. Now, this is important because your peer set, ultimately this approach to valuation is also garbage in, garbage out. आप peer set कैसे identify करते हैं वो बहुत जरूरी है. I mean, are the companies in terms of size, scale, geography, quality of management, etc., relatively comparable? No two companies can be identical. It's a given. But do they fall in a very reasonable range of differences? If it's a very wide range of differences in terms of those qualitative factors, then there is a challenge. Okay. Then, of the peer set, you calculate the relevant metrics, the multiples. Now, you have the peer set multiples. You come to the target company that you are talking about. Here, if you need to make any adjustments whatsoever to ensure that it is not an outlier in comparison to the peer, you do that adjustments and then use the peer set to compare it with the valuation, either compare the valuation that you have arrived at or to compute the valuation range on the basis of the peer set. या तो आपने ऑलरेडी वैल्यूएशन कंप्यूट कर लिया है तो अब आप ये कर रहे हैं कि कंपेयर कर रहे हैं कि भाई बाकी जो कंपनियां हैं इसी इंडस्ट्री में, इसी where there is reasonable homogeneity across the industry and across companies, whether this company that I have calculated falls in that range, or if I have not calculated this, कोई बात नहीं, ये रेंज आता है, अगर इस रेंज को मैं देखूंगा तो ये कंपनी का वैल्यूएशन इतने से इतना होना चाहिए, मोटा मोटी. Then you see there are two parts. One is the company valuation. The other is the stake valuation. There are you have to bear in mind, again, just trying to sensitize you to the issue. Company valuation and stake valuation are two different issues. Company is so just because a company is worth, say, for the sake of argument, 100, 5% of that company is worth ₹5, but 26% of that company may not be only 26. And 51% of that company may not be only ₹51. 76% of that company may not be only 76 rupees. Because there is a premium or, depending on the circumstances, discount applicable to that transaction. So just very small, bear in mind, the suitable premiums or discounts need to be applied to the valuation thus arrived at in case of stake transaction rather than a company valuation. What are the advantages of comps multiple here? Yeah, please understand that in case of listed companies, at least, you are arriving at a comparable valuation on the basis of prices that actually exist for multiple such similar companies. So there are enough people in the market who are willing to pay that price for that company, and hence the price is fairly, reasonably well established. Reasonably, may not be just about adequately, may not be in entirety, but reasonably well established. Okay. Again, basis the performance of those companies. So now, once you sort of straight line the performance of the target company with the performance of the peer set, you will be able to get a reasonable sense of what the valuation of the target company will be. And multiples are possible. Many multiples are possible. So there are a few multiples that we use. I will be showing them on the screen in a bit. But at the same time, there are also disadvantages. Primarily being, in case of comms, if there are any synergies possible with the acquisition, in case of an M&A transaction, those are excluded. Now, here I'm talking about synergies possible in an M&A transaction. If it's a pure investment-related decision, it's a different ballgame altogether. Okay. Again, to a large extent, what you will be able to figure out or calculate is on the basis of the past numbers. It still gives a trend, it still gives you a sense, but it is still on the basis of the past number, not necessarily on the basis of the future numbers. Outliers, if any, can create a challenge. And so enough time, attention, and energy needs to be given to any outliers that are found in the peer set. You can take a clinical approach which says top 10% and bottom 10% I will ignore any which ways. Or if it's more than a particular level of standard deviation, I will ignore it. But at the same time, it is always useful and better to reassess as to why those are outliers. If it's a genuine outlier, if the valuation that has been computed deserves to be as an outlier, let it be. That will be a good sanity check for the target company also. Okay. And as I was mentioning, in case of stake sales vis-a-vis complete stakeouts, they also require reasonable adjustments on account of control premiums and discounts. What are the metrics now? Let's look at what are the various metrics that we use in case of calculation of enterprise value. Here, why enterprise value over equity value is because the entire focus is on the business as a whole, not on the equity or not on only the net worth of the company. The business as a whole versus the pure owner's stake, there's a difference. There will always be debt in the company in most cases. And hence, the value of the business as a whole is different from the value of the stake held by the owners of that company. Okay. For those who are formula driven or for those who wish to understand this a little closely, The enterprise value is always the value of the company, assuming it has zero debt in the balance sheet. I repeat, the enterprise value of any underlying business or company is calculated on the basis of the assumption that it has zero debt in the company. If it has zero debt, it's the value of the business as a whole. From that, once you reduce the debt, then what you get is equity value, but more on that a little later. Okay. The key EV metrics. EV is the term used for enterprise value, while equity value is also EV. But whenever you use the term EV, you refer to enterprise value, not to equity value. Oftentimes, while writing in a report or anything, you use the term EQV, E and then small q and then V, and that is to represent equity value. But EV alone, standalone basis, refers to enterprise value, which is the value of the business as a whole, not just the stake of the owners. Okay, EV is value of the business as a function of its revenue, how many times? Value of the business as a function of its EBITDA, how many times? EBITDA or EBIT or EBITDA. Now these are EBIT. These are used interchangeably often, and there are reasons. There could be because of the nature of the business, there could be because of the stage of the business. And EV as a function of total capital employed, and EV as a function of capacity. I also allow me to just take a small pause here and highlight to you that throughout my presentation, the lists are not exhaustive. They are only indicative. So there will be more metrics like this throughout my presentation. Across all the slides, whenever there is a list, whenever there are features put in, that's not expected to be, I have not designed it to be an exhaustive slide, but I've covered what most you will want to know about. Let's look at what these metrics really, I will have to, sorry. What do these metrics really mean? When you talk about EV as a function of revenue, what you're talking about is what is the value of the company as a function of its revenue. The advantages is if there is a loss-making company, you can't do EBITDA or EBIT because there's a possibility that it might be negative. Just because EBITDA or EBIT is negative doesn't mean it is a negative value company. Okay? However, the disadvantages, it does not take into account the profitability. When you're talking about revenue, you're not talking about profitability. And we have read enough examples in the papers over the last few years where we are talking about companies, higher the loss, higher the valuation. How and why that happens is a slightly different mindset altogether. Maybe we can discuss it in a separate such a VCM where we talk purely about PE and VC investing approach, but not today. EV to EBITDA is the next one, which is what is the total enterprise value of the company as a function of its EBITDA. So 6 times, 7 times, 8 times, 10 times. That is the broad range depending on the stage, the age, the kind of industry that the company is in, etc., etc. Here, the advantages, your accounting changes are assumptions are more or less discarded due to not taking into account your interest as well as not taking into account your depreciation and amortization. EBIT, again, while you are taking into account the depreciation, you are still not taking into account the leverage in the company because interest, the EBIT is before interest. So you are not taking into account any impact on the financials of the company on account of the leverage, which means on account of debt. So interest is ignored. And obviously taxes is ignored because tax is a function of the legal entity, not necessarily a function of the business. Okay. And lastly, you have EV as a function of capital employed. Again, for certain businesses, this is best suited. It has its pluses and minuses. For example, it does not take into account the profitability, if any, which is not, as also any accounting distortions is a challenge. But at the same time, if there are businesses where the capital employed itself is a key driver, so companies which require a long gestation period. Typically, in those companies, capital employed, unless and until something goes awry, will be a very good indicator of what kind of valuation it will, what kind of returns it will be able to generate. And hence, EV is calculated as a function of the capital employed. Okay. Again, there was one more matrix we talked about, which is the EV as a function of capacity. Let's just look at this. What do you mean by EV as a function of capacity? Well, it's easy to calculate enterprise value on the basis of financial numbers. It also helps if you, as a check, can find out how much are you paying for example, for a healthcare company or hospital. Every bed is a revenue driver and hence the value driver. Profit comes from every bed. How much am I paying for buying a hospital on a per bed basis? Or in case of a hospitality or a hotel, essentially what is a revenue driver? A room is a revenue driver. So if it has, say, 20,000 rooms, how much am I paying per room? That will determine whether, and then I will compare that with other peers as well. I will show that as well. That will help you determine whether the valuation that you are paying is reasonably in sync with the industry standards or the going rate currently on the basis of certain metrics in the industry in the recent past, or are you an outlier? If you are an outlier, is there a valid reason for that? Is it that the profitability of this particular hospital or hotel is much better than the others? Or does it have sort of a monopoly in certain geographies, which should also result in better profits, if not already, then at least in the future? Again, as you can see, across different industries, there are different metrics. If it's a multiplex, you're talking about either per screen basis or maybe per seat basis, so on and so forth. You may recall, I was telling you in certain cases, it's always price equity rather than this thing. If you look at BFSI, it's always price to book value. Book value is nothing but total net worth. If you look at the left column, bottom one, BFSI, it's price to book value. Again, I may talk about this later, time permitting. Yeah. I have just tried to encapsulate a live example. This is from a research report, not our research report, of the enterprise value as a function of EBITDA of cement companies in the country, some cement companies, not all, and these are from the listed space. You can see that there is a range of valuation. Okay, and depending on whether you are considering FY19 numbers or FY20 numbers or FY21 expected guidance numbers or FY22 guidance numbers, there is a range of valuation which you can see here. And not just this is EV as a function of the expected actual or expected EBITDA. In addition, there is also the EV per ton of manufacturing capacity. You recall in that list of EV metrics, the last one was EV as a function of capacity. This is what represents. Now, while here it seems, for example, ACC, if you were to buy today, assuming that research report is valid for today, you are buying at 8.7x EBITDA. Whereas there are others available at lower as well. Okay. But if you look at, and then you look at the enterprise value per ton, you realize this is definitely closer to the middle rather than an outlier. Now, basis this, you decide whether the company, you always decide on the basis of conjunction of both these and a few others also, but I'm just giving you a sense of how an analyst or how a M&A investment banker uses data to then justify or deny or reject the decision that he's made. So again, now having talked about enterprise value, let's now move on to the equity value part. Equity value relatively is easier to understand and calculate because essentially you're taking one of the profit indicators and or net worth indicators and you're comparing it with the equity value of the company. And if you recall, equity value I had mentioned is nothing but enterprise value less total debt in the company. Okay. Now, I have, so after considerable thought, I had written this line. It can be misleading in certain cases, and I will talk about that in a minute. The advantage is that it already adjusts the capital structure in your decision making. If you are arriving at the equity value, the capital structure that exists in case of the target company has already been taken into account. It has been discounted for. And hence, the equity value is always highly susceptible to the debt equity ratio of the company. So it moves as a backward bending graph. As debt equity ratio increases, your equity value increases. But beyond a point, it starts reducing. So again, that's for another day's discussion. In short, let's just look at what are the equity value metrics. This should have been on the previous slide. I'm sorry. So these are the. Just give me 1 second. I'm sorry. I think there's one slide missing. But okay. So the most commonly referred to equity value metric is the P ratio. P ratio is nothing but my price per share divided by the EPS per share. I repeat, price per share divided by EPS per share. The most commonly used one. Not necessarily the best indicator, but definitely the most commonly used one. It just calculates a net benefit to the shareholder, to the equity shareholder, and how much does he have to pay on a per share basis for that. This indicator is as in, okay, simply put, this is the most commonly used one, though not necessarily the most suited one. Next is the price to book ratio. I was mentioning earlier, there are certain businesses where the PB ratio is a lot more suited than any other. Say banks, companies with long gestation period, companies with a sort of a capex mode with them. There, a PB ratio is a better indicator of what the valuation will be in comparison to any other. A new variant that you see over the last decade or so is the price as a function of cash flow per share. While earnings is important, we have reached an area, stage where people, investors, investment analysts have realized the importance of cash flow rather than only earnings. Earnings can be, manipulated. Cash flow cannot be, which is where they go a step forward and say, okay, while on an earnings basis, the price earnings ratio is this, the P ratio is this. Let's also calculate what is a P to cash flow ratio, which is a better indicator of how much of earnings are getting converted into cash flow. And on the basis of the cash flow being generated by the company, how much am I paying? Which is a lot better indicator, especially if it's a capex heavy company or if it's a company with a very long working capital cycle. Sorry, so this got swapped, my bad. There's one more, which is a price to dividend ratio, but this is purely for textbooks. In real life, at least in an economy like India, nobody uses the dividend yield or price to dividend ratio. And hence I use the term used in there. It belongs to the museum, it belongs to textbooks. Except in case of those economies which are extremely, at the a complete, where there is no growth, no further growth possible. It will continue to grow at the minimal growth rate of 1.5%. Their dividend yield might make a difference, or dividend yield might have a bearing or a say. But otherwise, in a growing economy like India, price to dividend ratio has no relevance. This is what we could, Now, having spoken about the listed companies in reasonable detail, let's move on now to speaking about the approaches that we take in case of private companies. Part of it is something that we've already seen or covered in case of listed companies. We will look at some more in case of private limited companies. The typical approach to valuation used in any private limited company is a DCF. Now, this would hold true for almost all cases where the company is not in liquidation, where if the company is a going concern, even if it is not a growing concern, chances are you will be using DCF for valuing that company if it's a private company. I repeat, if the company is a going concern and not a liquidation company, or it's not a distress sale, chances are you will use DCF for valuation. Abetted and aided with comparable multiples and transaction multiples. Now, what's the difference between comparable and transaction multiples? Not much. We will talk about that in a minute. Let's look at the DCF per se. I will, however, I would like to say, while I am not here to cover DCF approach, because that could be another 3-4 hours of a separate VCM, but let me at least highlight to you what are the summary steps that are taken in case of a DCF and why DCF. See, the whole genesis of a DCF approach to valuation lies in the fact that, one, cash flow is king. No matter what the accounts say, accounts can be manipulated, financial statements can be manipulated, but not cash flow. If the cash flow has been generated by the business, it cannot be hidden. If it has not been generated by the business, then it cannot be created purely by accounting gimmickry. And that's why DCF uses the cash flow approach to valuation. Second, it uses the very simple principle of time value of money. Cash flow generation, yes, when at different points in time. If cash flows are being generated at different points in time, obviously, courtesy time value of money, the present value of that will be different from the time when they are generated. So DCF is nothing but a mixture of these principles put together, time value of money and cash flows, and the present value of all the cash flows that a business can generate over a period of time, over perpetuity, is the value of the company. That's in a nutshell how DCF operates. It is the most universally accepted and globally respected and used valuation methodology. So regardless of your economy that you're talking about, chances are the investment analyst or the research analyst or the investors in that would probably be using DCF approach to valuation. It's globally used. Just a quick summary steps required for calculating the DCF value of any company. You again, while each of them will require a lot more detailed explanation, but I'm going to keep it very crisp. You start with projecting what the future financial statements of the company will look like. So operationally, how it will perform and how will that convert into financial statements in the future, maybe for the next 4, 5, 6, 7 years, depending on the stage, depending on the kind of company. The test of how much should be the projections period is, by the end of the projection period, the company should have attained a steady state of operations and there should be no known expansion or no known change that will be occurring after the projected period. Basis the future cash flows, basis the future financial statements, you compute the free cash flows. And allow me to again, just pause here a bit and remind you, the free cash flows that we calculate for the purpose of DCF valuation has got nothing to do with our cash flow statement that we do in compliance with the accounting standards. This is very different. This is simply free cash flows to the firm or to the equity, depending on which approach you're taking to valuation. I don't want to complicate that. Just let's call it free cash flows for now. The free cash flows that you've calculated for the period of projections are now required to be discounted to the present worth, to its present day, which is today, the time when we are doing the valuation. For that, we discount it to present on the basis of the weighted average cost of capital, or WACC as it is commonly referred to. So far, future financial projections on the basis of which you compute the free cash flows, and you discount the free cash flows to today on the basis of by using weighted average cost of capital as a discounting factor. Okay. In parallel, you also compute the terminal value. There are 2 or 3 different approaches to computing the terminal value. The most commonly used one is using the final year projections cash flow and then compounding it at a standard rate and then arriving at the terminal value. Terminal value is calculated at the end of the projections period. Now, this also has to be discounted to today's worth, today's present value by using the same WACC. And when you summate the two, summate this and this, what you have, this and this, what you have is the final value of the company. It is either enterprise or equity value. If it's enterprise value, you can move from enterprise value to equity value by deducting the debt as on date. If you have anyways calculated the enterprise equity value directly, then there is no need to separate do that. You have to bear in mind, so certain things have to be borne in mind. If you are using WACC, then invariably you are calculating enterprise value. If you need to calculate equity value directly, then you will have to use the cash flow calculation will be different, and the discounting factor will be cost of equity, not cost of capital. Okay. Now, talking about cost of capital, kindly note the way to calculate the cost of capital is. Okay, I'm not even talking about the way to calculate. I'll just talk about what are the ingredients which go into the making of the calculation of the WACC. Essentially, your cost of debt, your cost of equity, which in turn depends on 3 factors, which is the risk-free rate of return in the economy, which the market risk premium that one would expect in that economy from any well-diversified portfolio investment, and the beta of the underlying company. Once you got these put together in the correct formula, you can calculate what the WACC of that particular underlying business or the company or the unit or the brand, whatever it is that you're valuing is. Right? So again, as I was saying, I don't want to spend too much time on what DCF is, but just still wanted to sensitize you to what DCF entails. And mind I remind you, the DCF and all this that you see on the screen was also taught to us as when we were doing our final CA. Now let's look at transaction multiples. What do you mean by transaction multiples? In a nutshell, it is the same as comparable multiples, but the difference being here, the value is derived not by the market cap of a company or which is in the listed space. It is derived on the basis of implied enterprise or equity value from any M&A transaction. M&A transaction could be an acquisition, a sale out, an investment by a private equity or a venture capital firm, or a secondary transaction between shareholders. It could be of any such kind. On that basis, what is the implied equity and enterprise value is what is calculated. What also has to be borne in mind is that if you're using comparable multiples or transaction multiples, you have to ensure that they are reasonably comparable, because you cannot use comps out of a transaction which happened maybe 7 years ago. Industry, economy, circumstances would have been very different that point in time as compared to say today. If it is in the last 2-3 years, yes, possibly you can use it as is, or maybe adjust it for any factors which may have influenced that transaction or a particular set of transactions at a particular point in time. So, subject to such adjustments, any M&A transaction or transaction multiples from any M&A transaction that have happened in the recent past can be used and are normally used. Oftentimes, what analysts do is they provide weightage, which means transactions which have happened in the recent past are provide a higher weightage as compared to transactions which have happened in the long past. So this broadly covers the set of private companies. Now, private companies is a very broad term. I have tried to capture a little more in terms of what we do for startups. Now, whatever is applicable for private companies, in most cases will also be applicable to startups. Nevertheless, I have specifically kept a separate section on startups alone, because whenever I do any such a presentation, invariably the questions that are asked or queries that are raised by the audience typically depend or rather pertains to startups rather than to any in general very old, maybe 30-40-year-old private limited company. So I am hence spending the next 20-25 minutes on the 20 minutes at least on startup related valuations. Well, the first thing that I need to sensitize you to is that approach to valuation in case of a startup is very different. It is different as in there are multiple factors that need to be considered, including, and a very important one is how much of dilution is happening at the current level of infusion. Okay, if a VC firm is investing in a startup, everything apart, it will also have to bear in mind how much of dilution is happening. A true blue VC firm knows that it cannot dilute the current promoter too much, because it will need more funding at later stage. If it dilutes itself, if the promoter dilutes itself too much today, which means it will have very little equity in the business, in the company left at a later stage when more fundings take place. So पहले ही इन्वेस्टमेंट में अगर एज अ वीसी फर्म मैंने प्रमोटर से उसका 25-30% ले लिया और उसके पास 70% ही रहने दिया अभी, so what will happen is that the subsequent fundraisers, that 70% will go down to maybe less than 15-20%, which is a clear indicator that his interest in the company will die much sooner than later. मतलब मेरा जो 25% है उसका तो कोई वैल्यू बचेगा नहीं, बिकॉज जो प्रमोटर है उसका ही इंटरेस्ट बहुत कम हो गया है. So that is also, I repeat, the stake that is diluted is also goes into a big way in a startup valuation. मतलब अगर एक कंपनी को समझो स्टार्ट एज अ वीसी फर्म, मेरे को पता है इसको यहाँ से यहाँ पहुंचना है, इसके लिए अगर इसको $1 मिलियन की जरूरत है तो भी मैं 10-12% ही डाइल्यूट करूंगा, और इसको अगर $2 मिलियन की जरूरत है तो भी मैं 10-12% ही डाइल्यूट करूंगा, which means I am suo motu giving him double the valuation of what I would have otherwise given. But that's why I said approach to valuation in case of a startup is very different, and it may seem unnerving to a typical discerning investor. अगर आप typical investor हैं तो ये फंडा आपको शायद एकदम से थोड़ा अजीब लग सकता है, and you are right, your suspect is valid. More on that a little later. Also, startup valuation, हमने starting में आपको मैंने कहा था no valuation can be complete without a discussion on art versus science, and I very quickly browsed through the art versus science part. In case of startup, it is more of an art rather than science, because startup kitna bhi, 2-3 saal purana bhi kyun na ho, the reliability of data is low, and that's assuming that there is availability of data. Availability of data हुआ बहुत अच्छी बात है, अगर availability हुआ भी तो भी reliability थोड़ी low होगी, and hence the art of valuation takes over in a very big way when it comes to startup valuations. Okay, there are multiple methods. I am talking about only 4. There are many more. And invariably, depending on the experience of the investor, it could be an angel investor, it could be an incubator, it could be a platform, it could be a VC fund, an angel VC fund, an idea capital fund, or a P fund. Depending on their own experience, they may choose one over the other, or depending on the kind of companies that they invest in, which stage are they investing in. If they are investing at very early stage, they will choose one over the other. And oftentimes it is invariably a function or a hyperlay of multiple approaches to startup valuations, which then help determine the value that that the investor is willing to ascribe to the startup. Okay, let's look at the first one, scorecard method. So again, almost while it is an art, this is sort of a clinical approach to valuation. Here, so one thing that we'll have to bear in mind is typically used for pre-revenue companies. This may not be as applicable or as suitable to companies which are already generating repeat revenues. This is in case of a pre-revenue company, and you'll have multiple parameters, okay, which as a VC investor you are aware कि ठीक है, अगर मेरे को एक कंपनी में अर्ली स्टेज कंपनी में इन्वेस्ट करना है तो उसको 1 2 3 4 5 6 7 8 इतने रिस्क तो उसको इतने ब्रिजेस तो उसको पार करने पड़ेंगे. I will evaluate on the basis of those parameters, and then a judge as to what is the valuation that I'm willing to prescribe to the company that I, as a VC fund, am willing to invest in. Okay. So let's just look at this a little closely. First, we just look at the first 2 columns. So what are those parameters on which I am evaluating the opportunity? When I say opportunity, it's the underlying company which I'm willing to invest. And मैं उसको कितना weightage देना चाहता हूँ? How much weightage am I willing to ascribe to each of these parameters? And then I will rank the company as to how does this company rank as compared to the others that I have seen or the peer set. Once I have the management, or do they come with very strong experience? Okay, great. Do they come from very good B schools? Okay, great. I will give them a score accordingly. How large is the opportunity? ये कंपनी आज जो कर रही है, ये स्पेस कल परसों मतलब 5 साल में 7 साल में कितना बड़ा हो सकता है? If it's a very very large space, then I will give it a higher weightage than as compared to a lower weightage. मतलब अगर इसका it can reach global scale, excellent. I'll give it a much higher weightage. प्रोडक्ट और टेक्नोलॉजी इन्होंने जो अभी तक बीटा फेज में है, अल्फा फेज में है, कस्टमर बीटा फेज में, जिस भी फेज में है, कहाँ तक पहुंच चुके हैं? They are good, bad, ugly. Competitive environment कैसा है? Are there other players in the market who are doing or working on something similar? Are there larger players who are already doing it? I will ascribe the target company score or weight ranking accordingly. Have they been able to do, or are they very strong in being able to do partnerships which they will need, etc., etc. And इसको कितना कंटिन्यूस पैसा लगता रहेगा, सिर्फ एक राउंड में काम हो जाएगा या 2 राउंड, 3 राउंड, 5 राउंड लगते रहेंगे, बिकॉज as you will need more round, it will also impact the dilution that I as a holder will have to make. That's another factor that needs to be borne in mind. Basis that, I will arrive at a score. In this case, this is a sample, of course. I've arrived at a score of 1.155. अब अगर मेरे को पता है कि average pre-money valuation basis the comparable companies that I have chosen on the basis of my experience is 20 million. Now, this is a US example, and hence the valuation is much higher. Normally, in India, you will not see pre-revenue startups getting 20 million valuation. But since it's an example, if 20 million is the base case valuation and the score of the company that I have evaluated is 1.155, I'm ready to give a valuation of 23.1 million. So that, according to me, can be the valuation. इससे ज़्यादा नहीं होना चाहिए. This is how I will be able to calculate on the basis of the scorecard method. This is how I will compute the valuation of this startup on the basis of a scorecard method. Okay. Next, let's look at the Berkus method.
Pratik ji, sorry to interrupt you.
हाँ जी.
1 second. There's a query from Abraham Arnakulan. Abraham, please check at your own connections. I have already checked with my technical team. There is no such issues. Fine, Pratik ji. Thank you. Sorry to interrupt you.
My bad. No worries. I just hope he gets the view again soon. God bless. Excellent. Berkus is again a method relevant for pre-revenue companies, and here we look at various steps that the company needs to take in order to clear the what is commonly referred to as chasm of death in startup world. Company always has to go down before it can get back, and that is known as the valley of death or chasm of death. And basis of what are those progress elements, what are those steps which the company has already taken, and hence the probability of it being able to cross the value of death is higher. I assign range of values, and again it's similar to scorecard method with a small difference, where instead of simple factors, I am looking at the parameters that will exist in a company. And uska prototype sound idea hai, very good, I am willing to invest. So जो भी company का base value है उस पे मैं मतलब zero से start करूँगा, तो $500,000 I'll add towards that. If the prototype is ready, very good. Again, see, because these are US examples, these are very tech driven examples. But prototype in a services company also can be a beta customer, which means there is a client who's willing to accept the services and willing to possibly pay also on a freemium basis or whatever. क्वालिटी ऑफ मैनेजमेंट कैसा है, अगर इन्होंने ऑलरेडी ये पहले किया है. एक तो होता है कि मेरे कॉलेज स्टूडेंट्स हैं जो बाहर निकल के उन्होंने आइडिया कर दिया और अब उनको ये जोश में करना है. दूसरा है दे कम फ्रॉम वेरी गुड schools as in engineering colleges or these schools, and have 5 to 10 years of experience in the space that they are working in, and now they want to do this because उन्होंने ये already किया है. The probability of them being able to do this is higher than somebody else. Okay. Again, if their experience is in similar space, experience as in their past experiences in similar space, their ability to form relationships or bondings is also fairly high. I will ascribe some value to that. That way, I can have multiple such factors which I know will go towards the reduction in the risk that this company will be able to one, survive and then subsequently perform. On each of these factors, I will ascribe a value and then add this up, and this is how I will arrive at my value which I am willing to give to the company. Again, as I was saying, this is a excuse me. This is a US example, and hence we have US dollars and million. But please appreciate the fact that even in India, if you're talking to a VC investor for a purely Desi Indian company, including which is into rural kirana distribution, you will still talk in terms of dollar valuations. You will not talk in terms of rupees lakh or rupees crore. That rupees crore and rupees lakh do not work in the VC world or the private equity world. It's always US dollar so and so million. Okay, the next one is actually the most commonly referred to one, and also it has the highest number of variables. It is simply put known as a venture capital method. And I repeat, to a pure play discerning investor, this might seem a little too out of place. But please bear with me for a few seconds and look at what this is. So see again, I was telling you earlier also, the VCs think very differently. They do not necessarily think in terms of price per share, cash flow per share. They always think in terms of full value of the company. What is the value of the company? And uske baad mera stake kitna hai. That is how they can't think in terms of per share. They don't actually bother, and they can't think in terms of per share price. If you have worked on any VC transaction, you would have probably realized that the price per share will be in a few thousands for a company which has a negative net worth and maybe 1 or 10 rupee face value. It's standard. It is not unusual. It is standard procedure because VCs don't care about per share. They think in absolute terms. Again, what we see, the venture capital method of valuation talks about is, in a few years' time, how much is this company expected to be worth? I repeat, in a few years' time. Today it is pre-revenue, but if things go well over the next 5-7 years, and if it's especially if it's a white canvas opportunity, it's a blue sea. मतलब कुछ का कुछ कहीं का कहीं ये हो सकता है. अगर बहुत बड़ा अपॉर्चुनिटी है तो 5 से 7 साल में इसका वैल्यू क्या होगा? वो जो वैल्यू हैगा, अगर 5 साल 7 साल बाद उतना वैल्यू है तो डिस्काउंटेड बेसिस पे आज के तारीख में उसका वैल्यू कितना है. अगर मेरे को समझो 35% रिटर्न चाहिए, 40% रिटर्न चाहिए, तो 5 साल बाद इतना है, 7 साल बाद इतना है, आज उसका कितना है. This is my yardstick of valuation that I'm willing to ascribe to the company. That is how VC venture capital method of valuation works. Find out what is the expected value 7 years, 5 years hence. Basis that, find out अगर मेरे को if I want to make a return of say 35, 40, 50%, उसका present value निकालिए. This becomes the yardstick of the valuation for that VC fund today. That is a value it will ascribe to this. The only thing you have to bear in mind here is when you're bringing it to the present value, you're talking about the post money. The post money, pre-money, I just realized I should have had a slide on that, my bad. But when you are bringing that to the present worth, you are talking about the post money valuation. From that, the VC fund will calculate the pre-money valuation. Let me just, again, as I was telling you, why, what do VC method of valuation, what are the underlying premises? One, VCs always think in terms of total value of the company. They do not understand other approaches to valuation. Total value kitna hai, itna hai. And reason being, see, please understand, these companies are a pre-revenue or very little revenue. They virtually no profit. Rather, loss nahi hai to bahut badi baat hai. Accumulated loss nahi hai to bahut badi baat hai. They will invariably have a very constrained cash flow cycle because they are continuously growing and hence they keep needing infusion. And that's why the typical valuation metrics, which we talked about in case of the listed companies, don't work in these at all. Again, as you know, the London Business School puts it, VCs recognize that valuation is not absolutely abstract notion. It is a function of how much somebody is willing to pay at one point in time or the other. So I'm creating, so the approach to VC investment is मेरे को आज पैसा डालना है, मेरे को 5 साल में, 6 साल में, हद में हद 7 साल में इससे निकलना है, which means निकलूंगा मैं कैसे? एज अ VC फंड मैं अभी से सोच रहा हूँ मैं निकलूंगा कैसे? अच्छा 5 साल में 7 साल में ये हो जाएगा, तो that company would possibly be a potential acquirer for this. I already am thinking of the exit plan, and that is how I will make money. Otherwise, I will not make money as a VC fund. And that is, I calculate that potential exit price. I'll come back and calculate the present value, and on that basis, I will invest. अच्छा, इस दौरान अगर मेरे को कहीं और इन्फ्यूजन लगा उस कंपनी में, तो मेरे को उसको भी डिस्काउंट करना पड़ेगा. That is a small complication, but I don't want to add to it right now. Let's just look at one example and try and understand this a little. Okay. Let's say that a VC fund knows that it can potentially exit at $100 million in about 3 years' time. And it is expecting to make a return of 25% on its investment. I repeat, it's expecting to exit at $100 million in 3 years' time, and it wishes to make a 25% return on its investment of $10 million. सबसे पहले तो मैं $100 million को 3 साल का 25% से डिस्काउंट करूंगा, तो मेरे को प्रेजेंट वैल्यू आता है 51 million, 51 million. Now, this 51 million, as I was telling you, is post money. Post money मतलब VC फंड जब 10 million डाल चुका होगा, उसके बाद ये 51 million होगा. तो अब VC फंड ने 10 million डाला है, उसके बाद ये 51 million है, तो उसके पहले कितना है? उसके पहले is nothing but the pre-money valuation, which is a 41 million example in this example, right? Okay, I'll move on, and in case you have any queries around this, you can post it, or obviously if you want to go through it in deep detail, you'll have the slides to go through. Okay, that brings me almost towards the end of the presentation, but just one more case. The first Chicago method is essentially a function of, okay, भाई expectation क्या है? क्या लगता है? क्या होगा? अच्छा ठीक है. I expect so and so will happen. मेरा expectation है कि मोटा मोटी ये होना चाहिए. Worst case scenario क्या हो सकता है? Worst case scenario ये होगा, that the company does not perform on this parameter, and hence the performance of the company will be something like this. अगर best case हुआ तो क्या होगा? So essentially, I'm drawing up scenarios as a VC fund. I'm looking at a company, I'm evaluating that company, and I'm creating those scenarios. Most likely scenario, worst case scenario, and best case scenario. Once I've done that, I will ascribe some weightage. कि best case scenario का weightage कितना होना चाहिए, worst case का कितना होना चाहिए, और best case का कितना होना चाहिए. Basis that, I will arrive at the weighted average valuation of that company. This is what is referred to as the first Chicago method. Here, you talk about modes and nodes. It looks at all the three. It can look at multiple cases, but essentially it looks at base case, best case, and worst case, and ascribes probabilities to it, and bases those probabilities and the expected outcome of the of that event happening. The valuation will differ in each of the three cases. The weighted average of these three is referred to is then computed as the maximum value that it is willing to ascribe to that company in case it is looking to invest in that company. That actually brings to the end of my formal presentation. I'll be happy to address any queries or questions that we may have. But I would like to use another couple of minutes to summarize why we, it is almost true. I used to wonder earlier कि अगर मेरा Excel अच्छा है, अगर मैं financial analysis में अच्छा हूँ, तो I should be great at valuation. That's not false, but it's also not entirely true. the art of valuation is something that comes only with experience. You hear something and you know by gut feel that इसका valuation इतना नहीं हो सकता. क्यों वो अभी नहीं पता. वो maybe one, and that keeps on niggling in your head, and you keep deep diving and trying to figure out either to justify why you felt or to negate it. कि नहीं ठीक है, your fear was incorrect. It has valid reason to be at this price or whatever. As you keep doing more and more valuation exercises, the art takes over in a much bigger way than the science, because science is relatively the easier part. There are not multiple directions in which you can go. Hence, so whenever I talk about valuation, I always say, while numbers are important, while the big picture is important, while objective is important, while perspective is important, the big test of any valuation exercise is common sense. And I would like to end with that. Thank you very much for your patient hearing. I hope I have been able to add some value to the 1.25 hour that I have been talking. If there are any queries or questions either today or later, you have my contact details on the screen. Feel free to write to me. I'm also happy to receive any brickbats that you would like to throw at me. If there is anything that I can do it better for the next session, please let me know. If you liked it, please let me know too. Thank you very much.
Thank you, Pratik Singh ji. Thank you very much. You can stop screen sharing, please.
Yeah, thank you, Pratik Singh ji, for your nice deliberation. And we have shortage of time and lot of questions are there. So I would request my chairman, C. Anuj Goyal ji, to take up the question answer session. Over to chairman, sir.
Thank you, Dr. Amit Agrawal ji. Thank you, CA Pratik Singh ji, for your nice deliberation. And of course, the contribution of CA Naman Gupta ji and the team Bharatpur, the Secretary Bharat Bhushan ji, and other managing committee members, Rakesh Gupta ji, Vice Chairman, and Hemant Kumar Agrawal sir, the Sikasa Chairman and past Chairman of the branch. We are having one query from R. Punappan ji from Chennai. The public sector company has invested in equity shares of a private limited company. The PSU is a company adopting Ind AS in its financial statements. The dividend is regularly paid. What is meant by the income approach of valuation under Ind AS? In my view, it is the average of last 3 years of dividend plus the book value of the private company. My decision is based paragraph B22, B30 of Ind AS 13. So will you please respond?
Sure. So, sir, very honestly, while I don't recall the Ind AS para clearly, the premise of Ind AS is fair value. So, is it only for the purpose of recording of financial statements? If that is the case, then if the underlying company is doing much better, or if it's a dividend paying company, then clearly it is doing much better. I don't see why you should not record it. You will be valuing it at cost because the value will be higher than cost. Value is not lower than cost if it's a dividend paying company. Does that address your query?
Rahul, if you can hear me, I think we have a guidance note on that.
Yeah. Rahul ji?
My voice is
So, sir, what we can do, Rahul, you would like to respond or I should?
Sir, you can carry on, sir, please.
Yeah. So, sir, we have one guidance note on that, and we would be reaching to member directly, and we will solve that query.
Okay.
Something.
Thank you. आप मेरे से भी शेयर कीजिएगा, मेरा भी ज्ञानवर्धन होगा.
Yeah.
Thank you. We are having one query of our very senior member from Kanpur, my good friend C. Sanjay Malhotra sir. In case of unlisted company, when valuation under income tax is compulsory from merchant banker. In case of unlisted company, when valuation under income tax is compulsory from merchant banker.
Under two circumstances, it is compulsory from a merchant banker. One, when it is issuing ESOPs. If ESOPs have been exercised, then the fair value can only be provided by merchant banker, not a registered valuer or a chartered accountant. And second, if there is any issue of shares to a Indian shareholder, so domicile of that shareholder to whom the shares are being allotted at a premium is India, then you either use Rule 11 UA, which is the book value or adjusted book value method, if DCF is being used. So if 11 UA book value method is used, then a CA can do. Actually, even CA is not required, the company directly can do. But nevertheless, most companies as best practice get it done from a CA. But if you are using DCF approach to valuation to arrive at the fair value, when shares are issued at a premium to a resident Indian shareholder, then a Cat 1 merchant banker report is a must.
Yeah, thank you. Then Mr. R.
And
Vaidyanathan from Chennai is having one query. Can ICAI or ICAI RBO publish data on valuation on startup entities like the multiples across healthcare platform, startup companies? That is, a number of deals are happening across the country. Some sort of dashboarding the same would help. Amiji, you like to
Yes,
respond?
sir. I would like to share the initiative taken by the Institute of Chartered Accountants of India. Yeah, of course, not right now, but very soon the institute would be taking such initiatives. We have a separate committee on startups and MSME, and at RBO level also we are at that stage. Very soon we will be coming out with these data. Thank you.
I'll allow me to butt in here. In my experience over the last 10, 12 years since I've been working in the startup space, I'll tell you, there is no publicly available data like this, except if you are looking at it purely from a valuation practice perspective. I repeat, if you are looking at it purely from a valuation practice perspective, there are 2 or 3 paid databases which give you extensive coverage of all deals that are happening in the country as well as across the globe. So they can help you with comps. But neither the government nor any other educational or any regulatory body is providing a consolidated data of this. There are certain in bits and pieces in certain industries, such transactions over a past are collated and provided by the large CA firms, but that's few and far between.
Yeah, thank you. So my good friend CA Manoj Agrawalji from Prayagraj, being a practicing CA and also a long-term investor holding shares in equity market, sometimes due to unavoidable circumstances, intraday activity, trading occurred. I think this question is coming up every day. Kindly clarify whether intraday trading resulting in speculative income or loss has been allowed or not for practicing CA holding full-time certificate of practice. So I think when we are allowing equity derivatives, so if due to some, yeah, Amiji, you would like to respond?
Sir, in our past deliberation on such kind of issues, we have asked to the members, whatever the suggestion they have, they can send us through email. We will deliberate first at secretariat level, at committee level, and then if found appropriate, it would be sent to council for a decision.
But to the best of my knowledge, if it is not due to the action of a chartered accountant or an individual member, it is due to unavoidable circumstances due to the systems in place, then I think there should not be any problem to that practicing chartered accountant. But of course, rightly told by Amiji, we will put it before the concerned authority and we'll come back. Then Kishore Kumar Paul from New Delhi, can our institute conduct regular classes on derivatives and enhance the knowledge of the members? We are of course having one, Amiji, we are having certification course on derivatives?
Yes, sir, we have certificate course on derivatives. We have certificate course on forex and treasury. We are very shortly we are coming with a certificate on fundamental and technical analysis and one on financial management and security laws. And apart from these 4 certificate courses, we would be organizing some training program a refresher course for private equity and other things also, equity research and other things.
Yeah, Mr. Satyanarayana from Vadodara, metrics to be discussed thoroughly. I think now he has already discussed the metrics. Pratik ji?
Sorry, I didn't get the question. Metrics to be discussed thoroughly. Is that a suggestion?
Yeah.
Okay. Satyanarayan ji, I'm happy to discuss it separately with you because I also had to do justice to the time given to me.
Of course.
So coverage that I've tried to give is as exhaustive as possible. When you try, doing something at breadth level, depth level, thoda sa impact hota hai. I agree with you, but jitna time tha uske hisab se I try to do as much justice as I could.
Yeah. Then CA Jagdish, very soon. Yeah.
Yeah, I would like to add something. Keeping in with the interest of the members, I think we can have a 2-3 days and intensive workshop or training program on that.
Yeah, we'll do it. I think we'll do it. Then CA Jagdish Haduji, very senior member from Pali, how the NSE, BSE index are raised or down, while the main index such as bank index, etc., does not vary in their prices or quantum of trading. What is the main reason?
Please understand that the composition of Sensex versus the composition of Nifty versus Sensex has 30 companies, Nifty has 50 companies. Sensex is nothing but a common weighted average of these 30 companies put together. Nifty is some 50 companies put together. They may not be coterminous. Bank Nifty is a separate index altogether because its composition is very different. So the two are not comparable. At a very broad level, you will expect them to move in sync, but they cannot be absolutely, coterminous or absolutely nahi ho sakta hai.
Yeah. CA Manoj Agrawal ji from Prayagraj, Allahabad. At present circumstances, stocks such as GIC, RE, Coal India, PTC India, Nelco, Tata Investment Corporation, Shipping Corporation of India, BSE might be invested or not as long-term investment. Kindly suggest. He is asking this query from each and every resource person. I think this is not the appropriate forum.
So technically, I'm not allowed to comment on. Yes. SEBI mandates us to keep mum on these. So sorry, we are governed by SEBI. I can't discuss individual stocks, not on a public forum.
Right. Then from Seeker, Mohammad Azruddin Chauhan, he's asking, can I get this PPT on mail? I think we will provide the PPT if we will get it from our honorable guest speaker.
Yes.
Then from Nairobi, Praveen Bajaj CA Praveen Bajaj from Nairobi is asking, sir, on which valuation parameters investors are investing in loss-making startups like Zomato, Uber, etc., where they are cash burning machine?
So there is one theory which is commonly referred to as finding the greater fool. All I'm trying to do is find somebody who will pay me more than what I have paid for something. In certain cases, that is almost true, though not all. See, please understand, while today they are loss-making, it's not expected to be loss-making. So if you have read Zomato's research report, you will see the amount of data that they are capturing, the amount of insights that they are giving, the amount of geography that they are covering, the amount of employment that they are creating, the amount of gig economy bits that they have been able to create. They have done a phenomenal job. No denying that. The fact also remains that they are loss-making, and that perturbs me. But there are enough investors who are willing to take a bet that when this turns around, the ability to generate profit will be much higher than its current losses. That's the expectation by which they are getting the kind of valuations that they are. I mean, today in the lockdown that we were at, I'm not an avid user of Zomato or Swiggy or Uber Eats, but I have used.
Yeah.
I'm sure all of us have.
Yeah. Then CA Madhu Chandalia ji from Kapasan, Rajasthan in closely held company at the time of transfer of share valuation is done by a CA or a registered valuer?
If it's a transfer, you're talking about, so if it's transfer, Companies Act does not come into play. If Companies Act does not come into play, then registered valuer does not come into play. RV is compulsory only in case of two acts, Companies Act and IBC.
Yeah.
So
Then CA Gunjan Agarwal, my good friend from Noida, in private limited companies, valuation, whether enterprise value arrived by DCF method is equal pre-money valuation, and for post-money valuation, present value of capital infusion to be added. Kindly confirm.
Okay. So please understand, whenever you are doing projections, essentially those projections should, ideally, those projections should be done after the considering the expected performance of the company after the capital infusion has been made. And if the projections are after the capital infusion, the value that you arrive at is also after the infusion, which means it's post money.
Yeah. Then CA Pranav, in present scenario in respect of hospitality industries such as hotels, restaurants, multiplexes, what valuation methodology needs to be applied and what factor needs to be looked to arriving at buying any business company? And secondly, what are the current valuation methodology used to value a startup?
Well, the second one, I hope I have answered in deep detail in the presentation itself. The first one, please understand, while there are multiple approaches to valuation for across industries, I'll pick only one of the many that you've listed. Let's say multiplex. Multiplex is simply put, either a function of per screen, what value am I paying per screen, and what value am I paying per seat. Both are important. If these are niche multiplexes with only say 40, 50, 60 seaters instead of the 400-500 seaters, the valuation will be very different per screen. So it will be a function of these two put together. However, now, while I should have said it in my main presentation, but let me say it now, a good chunk of the transaction is a function of negotiation, not just pure valuation. Valuation range is a good starting point for both the parties to sit across a table and then keep hammering out till they agree to something which is conducive to both the parties. वो सही ट्रांजैक्शन वही होता है, सॉरी गोयल जी, लास्ट वर्ड ऑन दिस, सही ट्रांजैक्शन वही होता है जब दोनों पार्टी उठ के जाएं और दोनों को ये लगे कि यार थोड़ा सा और हो सकता था. That is a correct transaction.
Yeah. Actually, we are having lot number of delegates from each and every part of the country. So if we can speak in English, that would be better.
My bad. So I'll repeat this. The best valuation or the best transaction is one where both the parties step out of the room and they feel that I could have got a little more. That's it. Little more. That's it. That's the best valuation transaction.
Then CA Avya Agarwal from Udaipur, Rajasthan. Sir, enterprise value considers debt or not? Since equity value is reducing debt, and you said enterprise value is better since debt is part of business.
It does. Enterprise value is including debt. It's of the business as a whole. उसमें से debt component minus करेंगे तो आप, if you deduct the debt component out of that, then what you are left with is the equity value.
Yeah. Then CA Bhaskar Prasad from Noida. What is the beta?
Okay, simply put, beta is nothing but the indicator of the riskiness of the underlying cash flows that you are valuing. So you're discounting cash flows, right? What is the riskiness of those cash flows? A mathematical indicator of that is referred to as beta. And in case of listed companies, there is a way of statistically obtaining the beta. In case of unlisted companies, you start with the industry beta and then move towards levered, unlevered beta, and so on.
Yeah, and then we are having one query from Delhi from Mr. Sumit. He is asking, I sir would be grateful if you can get this presentation. It is very knowledgeable. Request you can support by emailing. We will do it. And then from Sajal Jain from Bengaluru is asking, what is synergies?
Synergies is when 2 plus 2 is equal to 5.
Yeah. Yes. Right. Then
simply put.
Yeah. Then we are having CA Manish Gupta from Ludhiana. he is appreciating the webinar and the deliberation by our honorable guest speaker. And then we are having Chandrasekharan from Bengaluru. Few words about terminal growth rate.
Yes. So there are multiple views on that. My personal view is the terminal growth rate. See, remember I mentioned that the test of the forecast period is that every known change has been captured and the company has reached steady state of operations by the end of the forecast period. Hence, the terminal growth rate should always be equal to what the economy, so not the company, not the industry, but the economy is expected to grow in perpetuity, not in the long run, but in perpetuity. I repeat, the terminal growth rate should be the rate at which the economy as a whole is expected to grow in perpetuity. Typically, for our calculations, we use 2.5%.
Yeah. Then my good friend C.A. Vrinder Jindal ji from Noida. How to arrive at cost of equity if we are calculating equity value?
Well, there are three components to cost of equity: the risk-free rate of return, the market risk premium, and the beta. The risk-free rate of return and the market risk premium are relatively much easier. You will have it available publicly as well. So risk-free rate of return you can take as government bonds, because those are the risk-free as one can get in terms of investment. For market risk premium, there are enough research reports, enough empirical studies which give you an indicator of what the market risk premium for different economies are. And the beta is really the conundrum. Beta is where the bulk of your time, attention, energy, effort should go into calculation. There are again multiple approaches. If it's a listed company, great, but you mentioned it's not. So you start with the industry beta of that industry from actual listed companies. Now that's a starting point. Now let's see in terms of the different leverages, operating leverages and the financial leverages existing in those betas, because of the beta that you calculated from the from stock market is the leveraged beta. You unlever it, there's a mechanism to do that, and then you relever it at the debt equity ratio of the company that you are calculating. That will give you the true beta, and once you have the true beta, you have your cost of equity.
So we have to go fast. Lot number of queries are there. C.A. Vaibhav Gupta ji, my very good friend from Kanpur. What guidance should be there for calculating growth rate for perpetuity of a startup company?
I just mentioned
of a startup company.
I covered. But since you specifically asked for a startup company, I'll also tell you the probability of using DCF for a startup company is also low. So growth rate does not come into role play. If you are using DCF still, if you're using projections and combining it, if you're still using the DCF approach for a startup, please appreciate that the terminal value might be, because growth rate is needed only for calculating terminal value. For startups, calculating the terminal value may have a different approach to valuation. You may not use the typical DCF approach for that. You can use exit multiples. You can use other metrics to calculate the terminal value in case of a startup.
Yeah. Then C.A. Tarun Khandelia ji, my good friend from Junjunu, is appreciating the webinar and the deliberation of our guest speaker. Then C.A. Yaju Gupta ji from Kota, Rajasthan, is having one query. A few startups project losses for substantial years in the future, assuming there are no comparable companies. The idea is a breakthrough or new in the market. How would be the initial value of the business be derived for initial rounds of funding?
Who's asking this question? Is the company asking this question or the investor asking this question? If the company is asking this question, the answer is going to be very different vis-a-vis the investor asking this question. If it is a breakthrough, if it is something that does not exist, if it is something that is absolutely radical, chances are valuation will be the least of your problems. There'll be 4 guys banging on the door and wanting a seat on the table. आपको ऑक्शन करना पड़ेगा.
Yes. Yeah, right. Then CA Kirti Dikshit, my good friend from Kanpur, what do you mean by base case?
Base case is what is most likely to happen in this company. I mean, एक तो होता है बहुत aggressive, अरे ये हो जाएगा, वो हो जाएगा. And that is why I used that small cartoon on that. One guy says, okay, everything will be perfectly fine. The other guy thinks that this company will be the next unicorn in the making, and the third person thinks that oceans will dry up and all glaciers will melt and all mountains will collapse. So base case is what is the most optimum probability of what will happen in future with this company.
Yeah. Then CA Avya Agrawal from Udaipur City of Lakes, why scorecard method has percentage and how is it relevant?
If you are looking at startups, it is extremely relevant. Typically, scorecard method and the Berkus methods and the VC methods and the first Chicago methods, they are all used by VC funds, VC firms who invest in startups, and bulk of it is based on their experience of the own fund as well as collective experience of the funds put together. They are the ones who designed this. The VC funds have designed it. It's not designed by academicians or researchers.
Then the CA Amit Agrawal ji, my very good friend from Bhopal, another city of lakes, is appreciating the deliberation of our honorable guest speaker. Then Subramaniam Iyer from Kochi, sir, how is the status of ease of doing business and strength of patent protection laws factored into valuation of startups?
Patent protection, if the company has an IPR, clearly it will be ascribed more value than in comparison to any company which does not own an IPR and is doing something similar. That is one thing. Ease of business part is something that I could not understand as to what exactly you meant. I mean, if the company has progressed in terms of few notches ahead of its competitors, again, more valuation will be ascribed to, or there's a probability that at a particular valuation, there will be an investor in this company, but not in case of its competitors, because it has already got these two pluses. It has an IPR protection and it has crossed certain steps already.
Yeah, thank you. Then CA Praveen Bajaj ji, my good friend from Nairobi, is appreciating about this insightful webinar with great speaker. And thanks Anuj Goyal ji. If possible, I feel we should have more in-depth sessions to cover all topics and details. So we have already decided that we'll go ahead with this. And then CA Anil Joshi ji, senior member from Jaipur. It was very good, but in very broad terms, it was pleasure to participate. So we'll try to have more and more programs so that we can have the discussions in detail. Then we are having one query from Romil Kulkarni, CA, how to account for employee stock options in startup valuation.
Okay, so there is a white paper written by Ashwath Damodaran. Essentially, what I think what you mean to ask is how do you whether or not ESOPs should be considered at the time of calculating the per share value? The answer is yes. Even if the ESOPs have been granted, not exercised, and they may be exercised only in future, and hence those shares will come into existence only in future. When you are calculating the per share value today, they still need to be counted. There's a research paper, white paper written by Professor Ashwath Damodaran. It might be useful to read it.
Yeah, thank you. Then CA Mayank Jain ji from Noida. In case of an unlisted private company, if equity shares are being gifted by mother to a lineal descendant, can the value be taken at lower than FMV, like at face value?
This is an income tax issue. There are separate rules for gifts between blood relatives. I think that should cover it.
So we'll try to answer it separately. Then CA Lokesh Jain ji from Noida. I'm sure these courses will do a word of good to the young brigade. Yes, certainly this is the time when the young brigade should certainly take up all these new avenues for the chartered accountants. Then Suketu Saha from Mumbai. If a startup company in which investment made, however, at present valuation is zero or negative, can one claim capital loss by writing off this investment, or else how to claim loss?
If again, income tax issue, and very honestly, I don't claim any fame towards income tax, but if you have already written it off in your books, I think that's a test. So if the company may still be a dead company, but you will continue to hold the shares. But if you have written it off, then I think.
Yeah. Then CA Manoj Agrawal ji, my good friend from Prayagraj, please provide PPT to all viewers. Thank you. So we'll certainly make it available. Then from Jodhpur, CA Prakash Purohit from Jodhpur is appreciating the presentation of our honorable guest speaker. Then we are having one query from Mathura, CAS Bhatia, my good friend. Sir, whether this is the right time to invest in PSU companies, since the government will make disinvestment of their stakes in many of these companies?
I can only say this: there will always be opportunities to invest in the worst of markets, in the best of markets. It's just that when markets run up, the opportunities are a lot lesser than when the markets are in the dump. But invariably, you will not have cash to invest when the markets are in the dumps. You will have. So I think I'll end it at that. There will always be opportunities to invest. It is not about markets, it's about the individual company. So look at each company individually, then evaluate whether that company, that sector, etc., will be able to do well. Then whether the valuations at which you are investing are juicy enough.
Yeah. Then see Harsvardhan Maiswari from Jaipur. While investing in a stock, is it better to look at the PE of company versus industry to look at whether valuation is expensive or not, or other valuation method like cash flow ratio of a company?
There are multiple methods that will have to be looked at in conjunction. P ratio of the company vis-a-vis the industry is one. Maybe also price to book ratio, maybe price to EBITDA ratio, maybe revenue to, maybe pure profitability margins across, maybe P growth ratio. Multiple factors. Again, valuation is one, then quality of management comes into role play, geographical diversification comes into role play, business diversification comes into role play. So in short, to answer your query, that is one of the various metrics that you should look at.
Yeah. Then CA Rahul Malhotra, very good friend of mine from Noida, a company like Paytm, which is active in digital payment and foray into traditional trading as well. Do we need to value separately or see valuation at company level and allocate value as per revenue contribution?
Since this is a company which is doing multiple businesses, you will have to use different approaches. You may have to use different approaches of valuation to value each business separately and then sum total item. So that's one thing that I could not cover due to paucity of time, sum of the total parts. You may recall SOTPs was one of the word written on one of my slides. That is sum of the total parts. That is applicable in businesses like companies which are very well diversified into different businesses and relatively unrelated business.
Yeah. Then CA Krishna Nandiji from Ranchi, capital city of Jharkhand. How to minimize the uncertainty of a positive news and positive valuation of a company when we take them into consideration and invest in the stocks, as sometimes actual impact on the stock market goes in opposite direction.
I wish I knew the answer to that. I don't have the answer to that.
Because there is no direct...
Another thing that I kept saying, one of the biggest factors to consider whenever you're doing any valuation exercise is common sense. And prior to that, I mentioned perspective. What is your perspective? If your perspective is 3 days holding, then your approach to that news will be very different vis-a-vis if you are looking to hold that company for the next 5 years. If you're holding it for 5 years, then a small delta of 1 or 2% will not make a huge impact to your overall return.
Yeah. Then CA Sakshi South from Jabalpur. Very informative session. Looking forward to more such sessions. So she is appreciating. Then from Hapur, my friend CA Yatish Gupta is having the view this webinar is interesting and I appreciate for this great subject. Lot number of queries are there from Raipur. My very, very good friend, senior member CA Sunil Johri ji is appreciating excellent deliberation and very good and timely step to conduct this seminar. Then
Have I lost it or?
Yes, I think there is some connectivity issue.
Yeah, okay.
So connectivity issue.
I just wanted to know whether I am still on or whether, yeah, I'm on. Audio issue, he's back.
Yeah. Then from Bharatpur CA Naman Khandelwal, the host branch member, what are the good resources available like website, books, etc. to extract the data while doing valuations?
So depending on what are you looking at, if you're looking at industry related metrics, then the websites will be different. If you're looking at financial historical data of listed companies, then you have BSE, you have Money Control, you have Ashwath Damodaran, who as good as considered as god of valuation. It has a lot of resources. The trouble or the flip side is it has so much of data that except for the extremely discerning valuation practitioner, for anybody and everybody else it might be too unnerving. So there are ample resources available per se. Depending on circumstances, if you reach out to me, I'll be happy to guide you as to where you can find what you need.
Yeah. Then CA Amit Goyal, my good friend from Agra, is also appreciating and asking for the PPT. Then CA Aditya Kumar Kesri ji from Devgar is also appreciating the webinar. And we are having from Raipur, Ramesh Chand Sancheti, he is also appreciating the efforts. Then CA Vaibhav Gupta from Kanpur is also appreciating this initiative. Then from Jodhpur, Kailash Narayan Purohit is also appreciating very good session through efforts from Manoj Goyal ji. And then from Siliguri, we are having one question. CA Abhishek Pavan ji, he is asking, with all due respect to all the metrics, they always help us to create a generic pool of business to rate and value, but given all the projections are either biased or tilted towards the developer of the financial model. Do you think any long-term, sorry, one second. Amit ji, see, some problem has been done. Yeah. Do you think any long-term investor can rely on these metrics looking forward, that is, while coming to a value?
Goyalji, you'll have to repeat the question. It was long and I lost
with all due respect to all the metrics, they always help us to create a generic pool of business to read and value, but given all the projections are either biased or tilted towards the developer of the financial model. Do you think any long-term investor can rely on these metrics looking forward, that is while coming to a value?
The answer is simply yes and no, because no denying that. See, again, come back perspective. What is the perspective of valuation? If you are valuing it as an investor, you would want to be a little more conservative because otherwise you will be the loser. So simply put, if you think those cash flows that the model has been created by the company itself and hence it's a little more rosy than otherwise, or it's showing a slightly rosier picture, the ascribing of risk to the underlying cash flows will increase. If the risk increases, what happens to my expected returns? My expected returns also increase. If my expected returns increase from the same set of cash flows, what happens to the value? which means because I think that these projections will not hold as true as they should, will ascribe lower value to the same set of projections as compared to some other investor who thinks that they will hold true.
Yeah.
So
Then
it's all about perspective.
yeah. Now we have to go very fast. We have to conclude. CA Kirti Dikshit ji from Kanpur is appreciating. Thanks for the explanation of query. Nice deliberation. Then we are having from Jaipur, CA Anil Joshi ji is also appreciating. Then from Agra, Mr. Subham Agarwal, CA Subham Agarwal is also appreciating. And from Raigad, CA Akant Agarwal is also appreciating and asking for the CPO hour will be credited automatically. Of course, the CPO hours will be credited, don't worry. Then from Prayagraj, CA Mukesh Kumar Agarwal ji is also appreciating the efforts. And then from Ujjain, my good friend Ritesh Kataria is also appreciating the efforts of the committee. And then we are having one query from Kanpur, Jitu. He is appreciating the opportunity for members have an insight on valuation. Looking forward to more sessions on the topic. And then from Bareilly, CA Arun Kumar Mathurji, please share PPT if possible. We will certainly share the PPT. Amit-ji, you please take care. And then we are having from Jodhpur, CA Mayank Mantriji appreciating the efforts of the committee. And then from Bhilwara, CA Pooja Jainji is also appreciating. It was a very knowledgeable seminar on valuation. Thank you so much. And then from Kanpur also, CA Sarath Saji, very, very senior member of the profession from Kanpur, my elder brother, is also appreciating the efforts. And then from Bharatpur, the host branch, CA Yes Gupta is also appreciating. And then from Udaipur, Sakshi Amor is also appreciating the efforts of the committee and the television of the speaker. Then from Kanpur, CK Arora ji is also appreciating very educative and informative session. And then from Bilaspur, CA Priyank Saluja is also appreciating. And then from Lucknow, CA Sunil Kumar Saxena ji is also appreciating the efforts. And then from Kanpur, CA Omkar Singh Kushwaha ji is also appreciating the efforts. And from Greater Noida, CA Sagar Regmi ji is also appreciating the efforts. So we are having a lot number of queries. We will not be in a position to take up each and every query. So thank you, Pratik Singhi ji, for very nice deliberation and answering all the queries of the delegates. We are having around 5,000 delegates from each and every part of the world. So over to Dr. Amit Agarwal ji.
Thank you, Chairman sir, and the speaker for the day. And it was really very informative session. And through these stories, we can understand the need of us, how the members of the institute are interested in such a subject. And through this webinar, this VCM, we come to know that a detailed deliberation is also required. So very shortly, we would be having some workshop kind of thing of 2 or 3 days, refreshers course of kind of thing. So definitely we will be coming out with that structure also. With these words, I would request Bharat Bhushan ji, Secretary Bharatpur branch of CIC of ICAI, for expressing forward vote of thanks. Over to Bharat Bhushan.
Thank you, sir. Thank you, Ramesh Singhal ji. Thank you very much today's learned speaker, Pratik Singhal ji. And also thank you, Chairman CC, MIP, CA Anuj Goyal ji. Also thanks to Naman Gupta ji, Amit Agrawal ji, Dr. Amit Agrawal ji, and all the members who are present in this webinar and get the benefit of this webinar. Thank you very much.
Thank you, Bharat Bhushan ji, our Honorable Secretary of the branch. Thank you, Rakesh Kumar Gupta ji, Honorable Vice Chairman of the branch. And of course, CA Pratik Singhi ji, our Honorable Co-opted Member of the committee, CA Naman Gupta ji, and all our honorable members from each and every part of the world. I think around 5,000 members have joined. And of course, CA Rahul Pal ji and Sakshi was there, I think. And Dr. Amit Agarwal ji, Secretary of the committee, CA Hemant Kumar Agarwal ji, very, very prominent senior member of the managing committee of Bharatpur branch and Sikasa chairman. And all the viewers, I will request all of you to please stay at home, particularly the members who are in our in India itself. And we are trying to have more and more programs, virtual programs of the CCMIP, Committee on Capital Market and Investors Protection, and the chairman of the research committee also. So, and the vice chairman of corporate laws committee. So we are trying to see that how we can have more and more virtual programs so that our chartered accountants can be engaged in the knowledge enriching activities, and they can be away from negative thoughts in this time of corona pandemic. And there are a lot number of negative news are being there, whether it is social media, whether these are news channels. So how we can remain engaged in the knowledge enriching activities and can sharpen our skills in this time of crisis, and can in turn serve the profession as well as can serve the nation also. So thank you very much all our honorable members from each and every part of the world for being very, very interactive and always being the part of our initiatives. Thank you, team Bharatpur, all our honorable managing committee members from Bharatpur, Bharat Bhushan ji, Rakesh Gupta ji, Hemant Agarwal ji, all the members of the Bharatpur, Rajasthan Central region from each and every part of the country and outside country also. Thank you, Naman Gupta ji, and thank you, CA.
Thank you all of you.
Thank you very much.
Thank you for this opportunity. It was a great experience for me.
Yeah,
Thank you very much.
Thank you, sir.
Yeah, very good evening. Please take care of yourself and your family members. Thank you very much.
Thank you, sir.
Thank you, sir.